9.1%. That is the year-over-year increase in the consumer price index. It is the largest increase since 1981. Now, I was around in 1981, but I was much more concerned about riding my big wheels than I was about the consumer price index. Today, we're going to cover an article that talks about how CPI is going to affect the economy here in the United States. And then a little bit later in the video, we'll talk specifically about how that impacts the housing market. But if you are new to the channel, welcome. My name is Brian. I'm a real estate agent here in the Boston market. And on this channel, we cover all things real estate. Now, full disclosure, I am not an economist by any stretch of the imagination, but I do follow this stuff very closely because, again, I am in the real estate industry, and this is very, very important stuff for me to follow and for you to know about because it impacts a lot of things on your end, whether you are considering either selling or buying. Like I said, we're going to talk about that stuff toward the end of the video. Okay, let's get into the article. Okay, this is from Bloomberg. It says U.S. inflation quickens to 9.1%, amping up Fed pressure to go big. U.S. inflation roared again to a fresh 4-decade high last month, likely strengthening the Federal Reserve's resolve to aggressively raise interest rates that risk upending the economic expansion. Well, that is kind of a misleading statement because we're not really in an economic expansion right now. We are in a contraction. The consumer price index rose 9.1% from a year earlier in a broad-based advance, the largest gain since the end of 1981, Labor Department data showed Wednesday. The widely followed inflation gauge increased 1.3% from a month earlier, the most since 2005, reflecting higher gasoline, shelter, and food costs. And of course, we're all feeling that, right? Economists projected a 1.1% rise for May and an 8.8% year-over-year increase based on the Bloomberg survey medians. This was the fourth straight month that the headline annual figure topped estimates. The so-called core CPI, which strips out the more volatile food and energy components, advanced 0.7% from the prior month and 5.9% from a year ago, above forecast. Again, not surprising. I think people are feeling the pinch everywhere. No matter where you turn, prices are up dramatically. The S&P 500 index opened lower while shorter-term treasury yields rose and the dollar strengthened. The red-hot inflation figures reaffirm that price pressures are rampant and widespread throughout the economy and taking a bigger toll on real wages, which are down the most ever in data back to 2007. The inflation data will keep Fed officials on aggressive policy course to rein in demand and adds pressure to President Joe Biden and congressional Democrats whose support has slumped ahead of midterm elections. That it has. People are, like I said, not happy about the situation we find ourselves in. Okay, let's talk about risks ahead. Several factors such as housing stand to keep price pressures elevated for longer. Geopolitical risks, including COVID lockdowns in China and Russia's war in Ukraine, also pose risks to supply chains and the inflation outlook. Rather than cooling down, inflation is heating up, Sal Gutierrez, senior economist at BMO Capital Markets, said in a note. While a pullback in gasoline costs in July and reported retail discounting will help tamp down the flames, the broad pressure in the core rate, led by plenty of inertia in rents, suggests inflation may not peak for a while and might remain stubbornly high for longer than anticipated. Yeah, I think that's absolutely the case. It's going to continue to rage. But if you follow this channel, we have been talking about inflation for a long time. So this should not come as a surprise to anyone that has paid attention to any of the videos that I've put out within the past year. Fed policymakers have already signaled a second 75 basis point hike in interest rates later this month amid persistent inflation as well as still robust job and wage growth. Even before the data were released, traders had already fully priced in such a move. Now they also see around a 1 in 3 chance that it could be a full percentage point. That is unheard of. A full 100 basis points increase in the Fed funds rate. That has never happened before. I would not be surprised in the least if it happens. It says 1 in 3. If you're reading between the lines here, that's essentially at least a 50-50 shot that it's going to happen. The higher and faster the Fed goes increases the risk for a potential U.S. recession, which several economists see in the next 12 months. Even so, the labor market has held strong, adding nearly 400,000 jobs last month. And this is what Bloomberg economists say. It was premature for some to preemptively dismiss the June CPI report as old news, as it shows inflation creeping up in places where it can be harder to squash. The Fed is right to worry about the unmooring of inflation expectations, and this report raises the chance of an even larger rate hike than 75 basis points down the line. Right? That's the 100 basis points. I'm not sure if they're going to talk about it in this article or not, but that's in July, the 75 basis points. That more than likely is going to be 100 basis points. And then there's another meeting scheduled in September where the odds of that being another 75 basis point increase in the Fed funds rate is almost certain at this point. Prices for household necessities continue to post outsized increases last month. Gas prices rose 11.2% in June from a month earlier. Prices for energy services, which include electricity and natural gas, increased 3.5%, the most since 2006. Energy prices are through the roof. I actually look at my electric bill that came in a couple weeks ago, and we were talking about it just as a family, and my usage actually went down. I want to say somewhere in the neighborhood of 10 or 15%, but the actual expense went up 10%. So when you combine the two, my energy costs were up nearly 25%, somewhere between 20 and 25% year over year. This is saying energy prices increased 3.5%. That is pie in the sky, totally inaccurate. I don't know what they're using to calculate that number, but if you're watching this video and you've looked at your most recent electric bill, I'm sure you're seeing the same thing that I'm seeing, which is an increase of somewhere in the neighborhood of, let's call it 20%. So say between 15 and 25%, probably about 20%. So this is like fantasy land, 3.5%. All right, if you stuck around this long, thank you. If you are enjoying content like this, make sure that you smash the like button and subscribe below. But let's talk about how this is actually impacting the housing market. And we'll do it from the two different perspectives, both sellers and buyers. Okay. For sellers, what does this mean? This means we're going to have even higher borrowing costs moving into the late summer, early fall. So right now they're hovering right around 6%, like 5.75%, 6%. Fully expect them by probably the end of July to be in the mid sixes, and then by the end of September to probably be in the 7% range, maybe 7.25%. If they're higher than that, I wouldn't be surprised. If they're a little bit less than that, I wouldn't be surprised. But either way, they're going up. There's just no way that the Fed can just stand by and let inflation just destroy the economy. So for sellers, what this means is there's going to be more downward price pressure on home prices because you'll have far fewer qualified buyers at certain price tiers, and people have less disposable income, right? So the debt to income ratios are going to be way out of whack. So I think it will impact the higher priced homes probably more so than less expensive homes. But even then, like everyone, like if you are pre-qualified for say $1 million and your affordability goes down by 10%, which is essentially what would happen when the interest rate goes up by a full percentage point. So for every 1 percentage point, your buying power goes down by about 13%. But let's just, for round numbers, let's just use 10%. So if you're pre-qualified at $1 million, now all of a sudden with an interest rate of, instead of, let's say 5.75, now it's 6.75. Now you can only afford a place that's about $875,000, maybe $900,000. So everyone gets kicked down the next level. So if you're listing a property at $1 million or $1.5 million or $2 million, you have far fewer people who can actually afford those homes unless someone's coming in with cash. But cash buyers, I mean, they are still out there, but nowhere near the same level that we saw over the past couple of years. For buyers, it is a double whammy. It is really, really difficult because you've got a couple things going, actually like 3 or 4 different things going on, but let's see if we can deal with them one by one. First and foremost, you're going to have, I know it sounds crazy, but fewer homes are being listed. Yes, homes are staying on the market longer, so you've got more choice out there in terms of available inventory, but the number of listings year to date, at least in my market here in Massachusetts, is down about 10% year over year. So what that means is you have fewer homes coming onto the market, and the homes that are coming on the market are typically homes that someone, they absolutely need to sell. They've gone to the homes that are just like trying to take advantage of a situation. Now the people that are putting homes on the market, they really need to sell this home. So in a sense, that's good because typically they're more motivated than someone's just putting it on the market just to take a shot. But the challenge is the rising interest rates. So your purchasing power goes down. So you're just not going to be able to afford potentially the home that you're looking for. You might be able to get a decent deal on something, but again, the homes that are like fully done, like reconditioned, moving condition, nice shape, or recently remodeled, those homes are still going to be sold for a premium. And part of the reason for that is because of the material costs and the labor costs to get these remodels done is significantly higher now than it was even just a year ago. The third piece here has to do with rents. And you heard, in the article, I talked about how much rents are going up month over month. I know in my market, again, in Boston market, the average rent, I just looked at this the other day, the average monthly rent in Boston, not Boston Metro, but Boston, the city of Boston, is over $4,000, right? It's a reflection of the increased costs in purchasing these homes, right? So the people who own these homes in apartments have to charge more. And in addition to that, because of the increase in value, the taxes are significantly more. Well, the homeowner isn't going to absorb that tax increase. So they're just going to pass that on to the tenant. So that's kind of like the double or triple whammy, if you want to call it that, for buyers. But here's the crazy part. Like, you still need to live somewhere. So would you rather purchase something and know what your expenses are over the next, say, 5 to 10 years, as opposed to being at the mercy of a landlord that could potentially increase your rent by 20% year over year? I know which option I would rather have. I'd much rather have a stable situation. So I would encourage you as a buyer just to not lose sight of the big picture. I know there's a lot of things in a state of flux right now, but even 5%, 6%, historically, those are below average in terms of borrowing costs. So it's still not terrible to lock in. And you still have the benefit of, in the event that in the next, say, 5 to 10 years, if the interest rates drop, you can then refinance. And that's essentially what happened over the past several years, is that people just who are in a, say, 4.5% mortgage, they refinanced at something in like 2 3/4 or 3%, and they saved themselves a bunch of money. A lot of people did cash out refis, and then they used that money to either remodel their existing place or purchase another place. So either way, still makes sense to purchase as opposed to rent. You are building equity. Is the home appreciation going to continue to rise like it has over the past couple of years? No way. It's probably going to flatten out, but that's okay, because again, it is still an asset. It's an appreciating asset over the course of time. Minimum 5 years is what I recommend. Depends on the market you're in, of course, but here where we are here in the Boston market, real estate values, they don't spike up like crazy high, but they also don't drop crazy low like in some of the other markets, like Phoenix, Los Angeles, Las Vegas, Miami to a certain extent, where it's just kind of boom and bust cycles. We just don't have that around here. So anyways, those are my thoughts. If you did enjoy this type of content, I just kindly ask that you smash the like button. See if I can get it to focus on my thumb. There we go. And click the subscribe button down below to be notified of future videos. Thanks for watching. Take care.